The broadcast is now starting. All attendees are in listen-only mode.
Okay. Hi everyone, welcome to our webinar, Let's Learn Futures. So this program is brought to you by LifeCham and sponsored by Bursa Malaysia. And our topic today is Case Study and Market Analysis of FKLI. So now before we begin, if you can hear me and if you can see the screen, can you please click raise the hand button? Okay, if you can hear me clearly and if you can see the screen, can you please click the raise the hand button? Okay, I'm seeing quite a lot of hands now. Okay, you can put your hands down. Okay, so my name is Smita and I'll be your moderator for this evening. So before we start, we'll just go to the disclaimer first. Whatever that is shared during this webinar is purely educational. We will not be responsible for any decision that you make to buy or sell, as this webinar is purely educational to teach you on investment. So for the whole year, we have planned a derivatives webinar, and our next webinar will be on the 4th of July. So the webinar will be in Mandarin. And as you can see, we have a whole list of the webinars planned until end of the year. So, okay, so our speaker today will be Miss Pauline Yong, who is the Managing Director of Sigma Wealth, Sdn Berhad. She is a certified financial planner and a licensed financial planner with Security Commission license and Bank Negara licensed financial advisor representative. So she has been in the training industry for more than 20 years. She was an economics lecturer for 16 years and now she is the course facilitator for the Financial Planning Association Malaysia, CPE courses. She has published 5 investment and financial planning books and currently a regular writer for various magazines and newspapers. Regularly, she's a commentator for CD Plus FM radio station every Wednesday morning for Stock Market Outlook. She received her MBA in Finance from University of Leicester, UK, and her BBA Honours in Finance from York University, Canada. In addition, she also is a certified chartist in Malaysia and a member of the Society of Technology Analysis in UK. So, Pauline, I will just hand over the presentation to you right now.
Okay, sure.
Okay. Okay.
Is it showing my screen now?
Yes, it's showing your screen.
All right. Okay. Hi, everyone. My name is Pauline Young, and I'm glad to be back again. So tonight, I'm going to share with you my personal experience about this futures trading. And actually, I've been an equity investor for many years, more than 20 years. However, as a futures trading, right, I just started in 6 years ago, 2001. End of 2012. In fact, it was end of 2012. So I think about 6-7 years. So because for me, my personality to be in this investing industry is that I can consider myself a very conservative investor. So I always think that trading is something that is not my risk appetite. So it's it's risky, it's dangerous, and then you will lose money, things like that. So then, but I wanted to try on trading because since I have already in this industry for so many years, and then I've been studying our KLCI index for more than 20 years. So I was thinking perhaps as a futures trader, I should trade the FKLI, which is our KLCI index. So that was my first trade on the FKLI, and then I have been trading FKLI since then. So in our Bursa derivative market, we have a few financial products, but the the most popular ones are FKLI and the FCPO. So I would suggest that for a starter, you may start with a FKLI, which is our KLCI index. And then if you gain more experience, then you go to the FCPO. Okay. The reason why FKLI, I would think that is because FKLI is more like at a slower pace than the FCPO. So that if you have made any mistake, right, this market is still forgiving. So you are able to recover. You are not like CPO. Sometimes you will see that the market move up and down too fast. Okay, so later I will share with you some of my experience. So today's content, I will start with fundamental analysis, because when we talk about FKLI, it's about top 30 component stocks. So those are the companies inside this the index that will move the index. So I'll talk about fundamental analysis, the technical analysis, the chart pattern. Okay, what are the bullish and bearish chart patterns, the indicators, and then the support and resistance, and then the case followed by the case studies. So in this webinar, because if you want me to talk into like very detailed, it is impossible. So I will take up the cream of the essence of this fundamental and also the technical analysis. I will take all the essence and then I will explain in the most, hopefully in the most simple way, so that it's easier for everyone to understand. Okay. So first, when we talk about the futures contract, we are looking at, the FKLI, and one contract will cost you 4,000 ringgit per contract. Okay. And then our underlying instrument is our Bursa Malaysia KLCI index. So I'll talk more about this later. Then the contract size is a FKLI times 50 ringgit. So 50 ringgit is 1 point. Okay, one index point is 50 ringgit. So if it moved by 0.5 index point, and that's 25 ringgit. And this 0.5 is the minimum price take. Okay, so every movement, the minimum is 0.5 index or 0.5 point, which is 25 ringgit. And the trading hour. The trading hour, you know, our normal equity market is 9 to 5, right? But for our KLCI, FKLI, the futures market, they start 15 minutes earlier and 15 minutes later. So we will start at 8:45 and then closing at 5:15. Okay, and the lunchtime, the lunch break will be until 12:45. So these are the trading hours that you need to take note, because usually for the 8:45 to 9 a.m., this 15 minutes time frame, usually the investors are very emotional. So if you are good in psychology, okay, you can understand the psychology of this trading. Usually for those people who are good in psychology, they can make the money from this first 15 minutes. Okay, but those have to be very experienced trader, then they can make that 15 minutes, they can make the money. Okay, so all right. Who are the participants? The hedgers and the speculators. Mostly will be the speculators. And the speculators will be me and you, and then all the market participants. Majority, we are the speculators, because we only speculate for profit. So that means what? That means we do not hold any underlying position, and then we just buy into the futures market. Okay, so that means either you can long or you can short. Long means that you buy now and then you sell higher later. Short means that you sell now at a higher price, and then hopefully that it will go down, and so that you can pick it up at a lower price, so that you can make the profit margin. So speculators, are we with risk? Yes, we are with risk. Okay. Okay, so for this KLCI component stocks, we need to look at the top 30 component stocks, because the movement of these top 30 component stocks will influence the FKLI. Okay, so usually for what I would do, I will look at the big cap stocks. So the big cap stocks will be like IHH, Hong Leong, the Petronas, and then, okay, go back, CIMB, Hong Leong Bank again, and then we have Public Bank. Just now, do we see Maybank? Maybank. Okay, Maybank is the largest component, 100 billion, 100 billion of market cap. And then Public Bank also quite big. Tenaga also 70 billion. So Samdabi also about 30 billion. So these are the top market cap company. So they are weighting. Okay, so this, because when we are talking about these top 30 component stocks, right? Each of them, they have their own market cap. Market capitalization meaning is their current price, current market price times the number of shares. Okay, so for example, Maybank, the market cap is 100 billion. So 100 billion meaning what? That means it could be their the price, which is 8 or 9 ringgit, then times the number of shares become 100 billion ringgit. Okay. So okay, now before I move on, besides you know about these top 30 component stocks, and then you also need to look at their technical chart individually, so that you want to know that whether any of these top weightage stocks have any technical weakness or any potential technical breakout. Okay, because when you are trading the FKLI, which is the derivative in the derivative market, when you're trading this FKLI, the performance of this FKLI is directly linked to this underlying component stocks. So if those top 30 like Maybank, Public Bank, and all these large cap stocks, they are experiencing some technical weakness. So either they have broke major chart pattern, the neckline, or breakout, whatever, then it will immediately reflect on the FKLI performance. Then you will know that if they have broke down, that means the FKLI will also break down. Okay, or if there's a potential coming to break down, then you will see that there's a potential for a short opportunity in the FKLI. So this part, I hope you understand. That means for this individual, you also need to look at their chart pattern as well. Okay, then we come to the fundamental. So usually for trading, right? Trading, we will focus more on the technical analysis, because the difference between investing and trading is that investing, we will look at the fundamental. We will say that about 80% is about fundamental, and then 20% is about technical. That's for investing into the stocks, individual stocks. But however, if you are looking at this trading, I would say that about 80-90% you are looking at the charts, the technical analysis of the chart patterns, rather than the fundamental. The fundamental is just giving you an overall picture, a big idea or macro view about what is happening. Okay, so I will go through briefly the fundamental. I will not spend too much time on this fundamental. So there's macro factors. So the macro factors, the first important one is the GDP growth. So this is directly linked to the stock market. You have good GDP growth, you have good stock market. You have poor GDP growth, the stock market will be reflected, because this is the like a measurement of the health of the economy. Then you have the interest rates. Okay, interest rate. So now we have recently reduced our interest rate to by 25 basis point, and potentially maybe there could be another round of lowering. So we are looking at it. So usually when you are looking at the interest rate lowering, right, because the relationship between low interest rate and the interest rate and the stock market is inverse relationship. So when interest rate low, then hopefully that will boost up the stock market, because people do not want to put their money into the interest rate, because a low interest rate kind of FD, because it's too low, then they will put their money into the stock market. Okay, so that's inverse relationship. If interest rate is high, all people put their money into the FD. Okay. Then you look at the crude oil prices and things like that. For Malaysia, this one is particularly important for us because we are more like a commodity country. We have FCPO, we have crude oil, so rubber and all these commodities. So this will affect our general economy. Then, of course, the property prices, inflation rate strength of the ringgit and fiscal policies. Then in terms of micro, we look at the industry or the competitors, the market share, consumer behavior, taste and preference, government intervention, industrial regulation. Okay, so all this. So perhaps if you were to talk about this, maybe you were looking back at the top 30 stocks, and then individually, any of these will influence for example, tenaga. Is it the industrial regulation will influence the tenaga or the telecom industry? The industrial regulation or the government intervention will have a great effect on the telco industry. So all this will be affecting. All right. Then, of course, this is part of the fundamental analysis, which is SWOT analysis. So I briefly just talk about what is SWOT. So SWOT stands for strength, weakness, opportunities, and threats. Okay. So strength and opportunities, these are the plus points. So when you're analyzing a company, you look at the strength and the opportunity, the positive side about this company. This company has any internal strength. Is their staff? Do they have a good management? Is the product selling well? Do they have, the management itself is very open, transparent, and whatever. So these are the strengths within the company. Whereas opportunities is the external factors that is influencing the company. So it could be due to exports. There's more export opportunities because of the trade war or something. So these are opportunities. Then the right-hand side, weakness and threats, these are the negative points. So the weakness refer to the internal negative points about the company. Maybe the staff turnover rate is high, the management is poor, things like that. And then the threats refer to the external threat that is influencing the company. Okay, so this is the SWOT analysis. So that's all for the fundamental. Now we focus on the technical because I believe I have a lot to say on the technical analysis. When I started to learn about this technical analysis, because I was a finance graduate, so all the time I always think that fundamental analysis is more superior, and it is the way for if you want to be a long-term investor, or if you want to be a long-term winner in this finance industry, fundamental analysis is good enough. However, when I get to know about technical analysis, I realized that perhaps these two can work together, and then you can improve your knowledge, and then you can become even more successful in terms of stock selection and also your investment. So then I started this technical analysis, I think about 10, maybe 8 years ago. And of course, after I have learned about technical analysis, my perspective changed a lot about the investment industry, because I can see that for this technical analysis, it is usually more towards mostly towards trading, but at the same time, you can also use technical analysis to look at macro view about a certain industry. So technical analysis itself comprised of many things. So the study of technical analysis is a big a subject that there's no ending to it. We have to keep ourselves upgrade to it. Okay. So basically, there are two assumptions. The first assumption is that history repeats itself, and then past trends predict future ones. So this is the first assumption of the technical analysis. So by studying the historical pattern, you can predict to the futures. So for example, head and shoulder. Whenever you see the head and shoulder, it broke, and then this thing happened, price drop. And then whenever you see a W sign, W chart pattern, and then you cut break through the trend line, and then the stock move up higher. So this thing keep repeating itself. Okay. And then number 2 assumption is that the price pattern is the sum of all the behaviors of the market crowd. Therefore, technical analysis tracks the psychology of the market. So it is a psychology game in the end. Okay, the whole market or the whole trading environment is about psychology, whether you are able to keep yourself in a emotion stable or not. Because sometimes when it comes to the time you're supposed to cut loss, and then you got emotional, and then you feel like you don't want to cut loss, and then the loss keep going. Okay, so these are your psychology. And then the psychology is that, okay, if everybody think the same like this, then shall I have a different thought? So that's also another psychology. So in the end, you have to think that this thing, the whole thing is about mind game, MIND, the mind game. So you are thinking about what others think, and then what you should react. Okay, so you are about thinking about how to fight with them according to the psychology. Okay, so so this is technical analysis based on these 2 assumptions. Okay, the basics of technical analysis. So this is the basic. That means at least you must know the time frame. The understanding of the time frame is important, because when you want to do a setup on your trades, you must have this time frame in mind. So whether you want to go for a short-term kind of trading style, or you want to go for a longer-term kind of trading style, so this time frame you must have it in place before you go into trading. Okay, so short term is between 2 to 6 weeks. Of course, you have a very short term, like within hours or within minutes or within a day. You call it the day trade. Okay, so that's how short the time frame is. Intermediate term refers to a period that lasts from weeks to months, about 3 weeks to 3 months. Then the long-term trend refers to a period that more than 9 months to 2 years. Okay, so when you're talking about trading, I would think that you are looking at this 2 to less than 6 weeks time. Okay, for usually some people, they like to be a day trader. So every day is a fresh day. So that means they will close the position at the end of the day. They will not carry the trade overnight to the next day, because every day they start from a fresh day. And another kind of trader, like me, I prefer weekly trading. So every week is a new day for me. That means every week I start from a fresh new day or calculation, because my P&L calculated is week by week. So you will have to trade on a weekly basis, because a lot of the time I notice when it comes to the weekend, Saturday, Sunday, although Friday it may look like that, but over the weekend, things happen in the world because of Donald Trump or because of North Korea, China. Things happen. Then on Monday, everything will be reversed. So that's why I would prefer to finish the trade within that week, so that I will not carry on to Friday, Saturday, Sunday, and then when it comes to Monday, it will be another situation. Okay. The charting basic. Okay. Now, to learn about technical analysis, the very first thing you need to learn is the trend. Okay, remember there's this saying say that trend is your friend. Okay, you have to follow the trend. So later I have a strategy to share with you. It's about trend. Okay, you just follow the trend, and then you will trade on the breakout. So how to measure the trend? So in order to learn about that trend trading strategy, you must learn how to draw lines. Okay, draw the trend lines. So it's very simple. You draw the trend line when you see the peak, and the peak, right? You just draw a straight line connecting all the peaks, and then that's the trend line, the upper trend line. All right, and then the lower trend line, you'll see the bottom, and then here there are 3 bottoms here. So you connect all these 3 bottom, and then you draw another trend line. Trend line has to be parallel to each other. Okay, parallel to each other, so that you can see that it's a very clear trend line that telling you that when it hits there, then it come down to here, and then when it hits here, then it come down, and then hit again, and then it go up. Okay, so the prices seems to move very nicely within this channel. This is called a down channel. It moves nicely within the down channel. Then this is a horizontal trend, the same thing. You connect the bottom and then you connect the top, and then you can see that it is moving in a horizontal manner. Hit the resistance. This is the resistance part, and then the bottom is the support. And then when it go up again, resistance and then support. And then the uptrend. The uptrend, same thing. You connect this line and then this line, and then that's the uptrend. It's very simple. Okay, so you need to practice on your screen by drawing the lines. Okay, for a start, you keep drawing this line. You can spend like a few hours just to draw the practice on this trend line. Okay, after you are familiar with this trend line, and then try to also draw smaller trend line also, because this is like a kind of like a medium term kind of trend line, because it's from 1 month to another month. So try to draw also within weeks also. Okay, small trend line, small trend line. Within this channel, you also have this down channel, up channel, down channel, oops, and then up channel, down channel. Okay, so you still have this zigzag pattern within this downtrend. Okay, so the trend line, you can draw a major trend line, then followed by a smaller trend line, so that you can see the actual movement. Okay, so a downtrend is formed by joining the successive peaks, and then maybe horizontal if the stock price is trading sideways. All right, trend lines can be used as support or resistance. Okay, so the steeper the trend line, the less significant it is. The longer the trend line, the more significant it is. So what it means is that when you go back here, okay, now when you look at this trend line, the longer the trend line, it means that it is carried like a few months already. A longer trend line compared to a shorter trend line, which one is more significant? The longer trend line is more significant because the time that it has carried for a long time. It has traveled for such a long time. So most likely that this the longer the time that it has traveled, so it is more importance. It is significance means importance. It will give you a more important message to you. Okay, when you want to make decision. And then the steeper the trend line, it means that the price is moving at a very fast manner. That means a lot of people are selling, or either it go down here or it go up here. Okay, it go up very steep trend line, and then it go down very steep trend line. So it means what? It means that people are participating around here and around here. A lot of people are participating that push the price in a short period of time in a very steep manner. And then this one here, the downtrend is very steep. So that means in a short period of time, people sell down, the volume spike up. Okay, so it's very significant. It is, you know, it is important in terms of analyzing the stock market. Okay. Then this one is another practice. You see this long trend line, and then you draw a long trend line. So another thing about this trend line is that, because just now I said, the longer the trend line, the more significant it is. So if let's say this trend line is a 10-year trend line, let's say 10-year trend line, and then the price broke below the 10-year trend line, what do you think about the impact on the stock market? Will it be huge impact? Yes. So if your trend line is 10-year kind of trend line, and then you broke below this kind of ultra long trend line, the impact on the stock market is huge. It's going to be huge. However, if you are looking at small trend line, a small one just within weeks, and then it broke below that small trend line, will it be a big fall? Well, it is only during that time it will fall for a short period of time, and then it will rebound again. Compared to this longer trend line, the fall will be longer. It could be 2 years of downtrend, because you are looking at 10 years of uptrend, and then followed by 2 years of downtrend. But if you are looking at a small uptrend here, then maybe the downtrend is about, if it's about 6 weeks of uptrend, maybe the downtrend is only about 2 weeks. Then it go up again. Okay, so you understand this concept about trend line. So the trend line is important because it will give you an idea that what happened when the price violates this trend line, the impact, how long is this impact? Okay, and the length of this impact is in proportion to this timeline here. Okay, so that's the important lesson or important essence about trend line. Okay, the length of the trend line will determine the effect. If should there be any violation, will determine the impact of this effect. Okay. All right, support and resistance is also very important. As a trader, this support and resistance is always at the back of my head. Whenever I'm in this in the trade, or even if I'm not in the trade, but this, at least I know that this KLCI index, what's the support and what's the resistance level. And this support and resistance will guide you in your trading, because no matter what strategy that you'll be using, either a trend line breakout strategy or a gap up strategy or indicator kind of strategy, this support and resistance is always have to be at the back of your head, and then to give you a guideline, where is the overall picture, where is the final support, where is the final resistance. Okay, and before you go into the trade, remember, ask yourself, where is the support and where is the resistance before you enter. So support is a level that buyers are willing to support that stop the decline. So when the price go down, and then it stopped there, and then it go up, U-turn. Okay, so this one is a support. Then the resistance is a when you go up and then it turn down. So that's your resistance, because it is difficult to break through. And then usually I would make it a round number, even though sometimes it's not a round number. I just make it a round number. Like example, 1647. It's not a round number. I just say, okay, 1650. Easy. Okay, so that because when we look at technical analysis, it doesn't have to be exact figure 1647. No, you don't have to be exact figure. You make it like a round number, because a round number is also a psychology number. 5 ringgit, 10 ringgit, psychology number. Okay. Then the resistance. Okay, so this is the resistance. I've said already. Then okay, once a support zone has been violated, it becomes a resistance zone. Conversely, once the resistance zone is violated, it becomes a support zone. So this one is an example. So initially, you look at this price chart here. The price has been wanting to break this resistance. This one is the top of it. So it has been wanting to break this resistance, and then it didn't not successful, and then it come down. Okay, and then it tried to break again, and then it come down, and then finally the third time successful. And then when it broke up, and then all the way, and then down again. And you see this down, this resistance, the top, the peak here become the support level of this time frame. Okay, so it means what? That means this same line, right? This same line can be a resistance and it can be a support of this stocks, particular stock or index. Okay, so when you happen to break the resistance successfully, then you are able to go up. And then, however, if you break down again, so then you are trying to break this resistance, and then finally you go up again. Okay, then in the end, you will try to stay above this support level. Okay, once the resistance is broken up, it becomes your support. Okay, as the time goes on, from left to right, that means from as the time goes by. Okay. Now the next part about volume analysis is that the word heavy volume is important. Okay. So heavy volume with falling price, heavy volume with rising price. So whenever you see heavy volume, that means there's a huge volume for that particular stock, followed by a rising price. So it is bullish. If you see a heavy volume followed by a falling price, it is very bearish. Okay, so this volume will confirm the price action. Okay, the volume will confirm the price action. So huge volume, if there's a rising price, it confirms this rising price. If it's under situation of a falling price, that means this huge volume confirm this falling price. That means it's bearish. Okay. Otherwise, when you have a light volume, it is like not so significant. That means the market is like not really pay attention to it, and then the price rise or price fall is just a normal market normal behavior. It's not so significant. Okay, significant ones are the high volume ones. Okay, so this is a illustration. So when your volume, this is your volume bar. So when your volume is rising, then your price is rising. Okay, so this is bullish momentum. However, your volume up to a point, your price still rising. Okay, your price still rising, but your volume has falling. It's falling. Okay, it's falling. So what does that mean? It means that as your price continue to increase, but your volume is reducing, does this confirm this price increase? No, this price increase is not a good confirmation. When your price rise and then followed by the volume rise, does this confirm your price rise? Yes, that means it confirms that this price is bullish, and then its momentum is strong. But for this one, as you see the volume is falling, that means this rising price, right, is not with the momentum. It doesn't get the support from the volume. So therefore, is this sustainable? This rising price, is this sustainable when the volume is falling? No, it's not sustainable. So very soon you will see the price start to drop. Okay, so these are if you're looking for psychology, right? These are psychology. Okay, all these are psychology. Then you have this your volumes rising, and then you are in the falling market. Okay, the price is falling. So as the price keep dropping and dropping and dropping, and the volume is rising and then keep rising, that means more people are selling. Okay, so under this situation, does this price fall? Is this price fall trend? Is this trend confirmed by the volume? Yes, that means this rising volume is confirming this downtrend. Okay, and however, if this price continue to fall and fall and fall, but the volume is reducing, okay, so that means this price fall, is it confirmed by the volume? It's not confirmed. So that means, will this fall continue to fall further? Very soon it will reverse, because your volume is not supporting this price fall, because people are thinking that the price is already too low. I'm not willing to sell anymore, so I'd rather not to participate in the market, and nobody participate, and then after a while digested, then the price will start to recover. Okay, so usually when you look into the chart, right, you look for this. Either you look for a peak, a spike in the volume bar, or you look for an ultra low volume bar. Okay, so there's two extreme. Either you look for a very high volume bar or a very low volume bar, because these things are the point of turning. Okay, so any trend, if you see this extreme volume bar, it could be the trend is reversing. Okay, so this is also another trick about this trading. Okay, the chart pattern. I hope I'm explaining in a very simple manner. If you have questions, maybe you can write down later, you can ask me. Then this chart pattern, it is important. Some people, their strategies is to use the chart pattern as one of their strategies. So when it comes to trading, right, we always must have a few strategies in hand. Just like when you are going for a war or something, you must have a few weapons in your hand, so that if this didn't work out, you come up with another weapon. If this didn't work out, you come up with another weapon. So these strategies are with you. Okay, you must have it. So one of the strategies here is this chart pattern. Okay, so that means you look for the opportunity to trade by looking at the chart pattern alone. And this chart pattern, does it come easily? It depends on your time frame. If whether you are looking at a 5-minute chart or a 1-day chart. Okay, so this chart pattern will, whenever you see this chart pattern, this thing will happen. Okay, for example, this is a typical double top pattern. Double top pattern, it means that you have a twin peaks, okay, like a mountain, 2 mountains. And then you draw a neckline. Between the mountain, you see there's a bottom here, right? Okay, you look at this as a bottom and then you draw a horizontal neckline. Okay, then this is your neckline, the chart pattern neckline. And this neckline is very, very important because you are looking for the opportunity for short, okay, for a short trade. That means you are looking for the opportunity to sell short. So when you see this thing happen, right, and then the price is very, very close to this neckline, and then you know that this opportunity has come. So you just wait there patiently for a breakdown. Okay, it's like you are going for fishing. You have to wait for this trade to come alive. So in order to come alive, you have to wait until this line cross below the neckline. If it didn't cross below the neckline, you start to sell, there's a risk involved. It has to be below the neckline. And when it below the neckline, sometimes when it just touched the neckline below and then it will bounce back up again. So you have to wait until it goes below the neckline for maybe 3 days. There's a time frame, maybe 3 days or a certain time frame, or maybe a certain percentage. Or another way is that when it go down, it rebounds a bit. When it rebounds, you see that it didn't rebound above the neckline. It rebounds below the neckline, and then that's the best time to sell. Then it go down again. Because when it rebounds and then it cannot pass through this neckline, that means that the strength is very weak. This particular chart is very weak, so that the chances of a big fall is very high. So then you will short. Okay, so the entry point is here. Of course, you must have a stop. Okay, the stop will be somewhere in the middle, and this stop is depending on your risk reward ratio. So if your target is about 3, then this one is 1, like 1/3, okay, 1 to 3 ratio. Or if you see a trend line here, like a 20-day moving average here or 200-day moving average here, then this can be also another stop, okay, according to the trend line. Or sometimes the stop can be the peak, the previous peak. Okay, you look at the previous peak, and then that could be your stop. So that means your stop level, it's according to your personal trade setup. Okay, there's no fixed rule. It depends on how you want to trade. Okay, it's your personal setup. Then this one, the target also, it depends on what your time frame, your target is. For example, you're talking about FKLI. FKLI is low volatility. Sometimes you go up 5 points, down 5 points, 10 points. Within a day, usually it's within that 10 points or 20 points. It will not be more than that. So therefore, you know the movement is very low volatility. So for this kind of financial product with such a low volatility, your target cannot be set too far. Okay, so it depends. But however, for this kind of a chart pattern, if you are talking about multi-years kind of chart pattern or multi-months, this chart pattern is built up from 6-month kind of a chart pattern. Then this downfall, there is a significance to it. Okay, so this downfall could last for about weeks. Okay, because you have violated like a 6 months chart pattern. So the downtrend here could be 3 to 5 weeks time. So if you know that the downtrend is going to be last you for 3 weeks time, can you set a further target? Yes, you can. Okay, so it depends on the whole setup. There's no right or wrong, but then it depends on your judgment. Okay. But the basic thing is that you must have a stop loss and then you must have a target. And then this is another chart pattern. It's called head and shoulder. This head and shoulder is more significant than the double top. So whenever you see a head and shoulder, you'll be more happy, because if there is a violation of this neckline, this fall is more dramatic than this double top, because this one is triple top. Okay, it's a head and shoulder pattern, it's a triple top. So, and then the duration perhaps is even longer than this one. So the impact over here is more significant than this one. So people, when they see head and shoulder, they are very eager to trade already, because the chances of a big fall is very high. Then these are the rising wedges. These are the smaller one, rising wedges, falling wedges. And the double bottom, inverse head and shoulder. Usually inverse head and shoulder, very seldom we see this. Usually we'll see a double top, because when it is you have traveled like in a down channel for a certain time, and then it go down, and then it will bounce back, and then it will go down, then the most of the time it will break up. Okay, it's a W. Very seldom you will have this kind of situation, go up, and then down again, and then up. The third time, then it go up, because usually when you have such a big fall already, people are very eager to get into, and then to get into the market, and then to buy again. Okay, unless the market is not so convincing, then you will have this kind of a down and down and down. Okay, so that means the market is not so convincing, and this one is quite convincing. Okay, then continuation pattern, that means in a super bull run, you have a horizontal trend, and then it followed by uptrend, and then horizontal trend followed by uptrend, horizontal trend followed by uptrend. So this is a super bull run, which means it's a continuation. Okay, just now it was a reversing up to a peak, and then it will reverse, trend reversing. Okay, it will no longer be uptrend, it will be a downtrend. But for this one, it's a continuation. Okay, so usually for the trade setup, I prefer this one, but this one is very difficult to come by. Once it come by, you have to maximize your profit. Okay, then you have to practice. Okay, so let's see. You see this chart pattern. Okay, before you have to learn how to look at this chart pattern, identify. Okay, if you are new to this technical analysis, you will have to practice looking at the charts. Okay, you look at this chart, and then you look at this up and down, and then you identify the bottom here, the bottom here, the bottom here. So then you ask yourself, can you draw a line here? Okay, yes, you can draw a line. So this is becoming your neckline. This is the head and shoulder, a neckline. Then this one broke down, and then it went all the way down. Okay, sometimes when it broke down, and then you have a slight rebound, and then it broke down. Sometimes it broke all the way down, and then have a small rebound, and then all the way down again. So that means what? That means this kind of pattern is a very weak pattern, because once it break, right, it break all the way. Okay, about 20, 30 points of down, and then when it pick up, the rebound is a very weak rebound. When you see the rebound, it's not like, wow, bounce all the way back to the neckline and then go up to the neckline. That's like the US stock market. Always when it go up to the neckline, and then it surpass the neckline, and then it go up to the resume the uptrend again. But for the certain market, most of the market, it is usually a downtrend. Okay, when it go down, and then the rebound is the best time to see how strong the market is. Okay, so if you have a strong rebound, you can see immediately. If you have a weak rebound, that's even best for you. It's an opportunity for you to trade. Okay, then target. Okay, the target, how you measure the target? So you measure the bottom here, you measure the peak here, and then you measure the height. Okay, and then you bring this height to the projection, and then you see, true enough, the price went down to this level, and then it go up again. So this is your price target. That means for technical analysis, isn't it quite predictable? As you can see, you just need to draw you identify a chart pattern, and then you need to draw the neckline, and then you need to draw the peak, and then you need to measure the height. After you have measured the height, you project this height from your neckline, and then you project downward, and that will be the price that is about to reach. And then after it reach your first target, and then it will go up. Sometimes if the market is too weak, after this first target, right, it will break down this first target, and then it will go to another bracket low. So the same height, it will go to another bracket. So that's under a very bearish situation. Okay, if it's a low volatility kind of a market, usually one bracket, and then it will go up again. Okay, so this is the price target. Okay, the chart pattern principle is that you have to be significance. That means how big is the pattern. The bigger the pattern that you see, it means that it is very significant, because it tells you that it travel a long period of time, like a 6 months or 2 years kind of a chart pattern. Then it is very significant. If there's any violation, the impact is huge. Okay, it will, and also prolong kind of an impact as well. You need to measure the height, and then you need to confirm the breakout by looking at the volume. Is there an increase in the volume to confirm the breakout? Okay, so all these things. Okay, the indicators, I'm sure you have seen this moving average. So let me go to this, straight away go to this moving average. Moving average is that you have 10-day moving average, 5-day, 20-day. Usually we look for the moving average that most technical analysts will look at, because the most popular moving average is a more reliable one, as in people will act on the line. Okay, when they see that this popular line, right, is violated, then everybody will act on it. Then it becomes self-fulfilling, and it will happen like that. So usually I will look at 20-day and the 200-day moving average. Okay, because these two lines are more very popular moving average line that everybody is looking at. And then when everybody is looking at, and if there's any violation, everybody will act on it, and then the impact will be huge. Okay, so when the price is above the 20-day moving average, it is short-term bullish. When it's below, it is short-term bearish. So for a longer term analysis, when the price is above the 200-day moving average, is long-term bullish. When the price is below the 200-day, it's long-term bearish. Okay. And the crossover, sometimes if you want to use a crossover, you may use it as an indicator to buy or sell. When the shorter line is above the longer line, 20-day above the 50-day, that's a buy signal. When the 20-day is below the 50-day, that's a sell signal. Okay, so this crossover is like a signal to buy and sell. Then of course this also have some rules, okay, confirmation rules. So it's a 3% confirmation rule. That means the price must be, after you have seen the cross, right, the price must be moved up or down for 3% of the value. Then it's a confirmation. Because sometimes when it just crossed and then it didn't cross above, and then it will go down again. Okay, so you have to wait until about 3% of confirmation. Then also you have to draw a trend line to confirm the moving average. For example, this one, you see there's a cross down, right? Then if you draw an upper trend line here, okay, if you draw an upper trend line here, there's also a trend line violation also, because this trend line, this price fall below the trend line. At the same time, also there's a cross here. So therefore, both trend line and there's a cross confirm this downfall. Okay. Okay, the longer the time span, the more significant the crossover. Okay, so, okay, then the next one. Okay, now we quickly come to this a case study, all right? So this one I did in April, now it's in June. Okay, so this is a price for April 26. So that was spot price was 1639, and then the bid price was 1636.5, offer 1637. Then you have two contracts, because when you are at the spot is April, then the following month is May. Okay, so usually if you look at the popularity, right, most people will trade the current month for the FKLI. Okay, so that means this the current month has a more liquidity. Okay, then you look at this trading planner. When you look at this, when you want to trade, right, what is your very first step? You need to have a trading plan. Okay, this trading plan, like for me, I have a booklet that I will record down all my trade. Okay, so every time when I trade, I will have to write down, record. So it is very important. It's like a trading diary. A diary is for you to reflect on your mistakes or your gains, so that you know how you make money and then how you lose money. So especially the mistake part. Sometimes from the mistakes you will learn, so that you will not do again the same thing, and then or you can react in a different manner, so that the actually for trading, right, you're bound to have mistakes. Okay, it's impossible that once you are in this trading, then you start to make money. That's a bit impossible, because if you are talking about trading, there's a risk involved. So but however, you will treat all those mistakes as a learning opportunity for you, because the more experience you have in the future, you are able to make more gains. So these mistakes that you make is like a foundation. Okay, you are just building up a foundation, just like a toddler who learn how to crawl and then who learn how to get up, stand, and then walk. So of course, the toddler will have a lot of fall. Okay, but however, you will treat every fall as an opportunity for you to learn more. So for trading, I think for us, if we have this kind of mentality, we can survive in a long-term manner. Okay, that means you can be a long-term trader, because if once you are in this trading, right, most likely you will be trader for life. Okay, because the more experienced you are, the chances of you making money in this trading business is higher. Okay, so of course you must have some strategies lah. So hopefully today my sharing of my strategy can help you in your trading. So for this trading plan, first you have to look at the overall market. So I'm using this Bursa station. Okay, Bursa station, and then you have to take out this chart, and then you have to analyze the big picture first. So you can see that our Bursa station chart, our KLCI index, we have a big chart pattern here. Okay, this big chart pattern is a head and shoulder, and then there's another shoulder here. So can you draw a neckline? Yes, you can. In fact, the neckline is at 1660. Okay, so now we are actually at 165 or 164. Today's 164.40. So we are actually below this neckline. However, we are struggling. We are struggling to move up above this neckline. So that means overall, you can tell the picture is a bearish picture. Okay, overall it's a bearish picture because we are now below the neckline. Okay, so however, even though overall it's a bearish, right, but it's up to you whether you want to go for a long position or a short position. So for a starter, right, I will advise you go for focus on one trend. Okay, if you want to go for long position, you go every time you go in, it's a long position. Okay, that means you go in long and then you sell high, and then you wait until it come down again, and then you wait for another opportunity for you to buy long, and then you go up. Okay, so when you focus in one direction, you are able to make better decision. Same things for the short. If you're focusing on the short, right, you just wait for the trend line to violate the uptrend. When the price is moving up nicely, you don't do anything. You just draw a trend line and then waiting for that uptrend to violate the trend line. And then once you see the trend line is violated, then you go into short. Okay, then you set your target. It's up to you. 5 points, 3 points is up to you. Then when it go down again, and then you see that the price trying to reverse, and then you wait for it to go up, okay? And then when it goes up, you just draw another trend line, and then you wait for another opportunity for you to short again, okay? So this way you are actually focused on one side, and then you are able to have more time to think, and then to make better decision. Otherwise, you can do both if you are very experienced. That means you draw the trend line, you long, it was a long position, you enter at a low point, and then it went up, and then you draw a nice trend line. So when the minute this price break below the trend line, you close your position, and then you sell short. Okay, you short, and then you draw another trend line for this short channel. See that the price move within the down channel, and then the minute that this price break above this trend line, then you close your position, and then you long. Okay, so this way you are doing both direction, long, short, long, short. So you can have that provided you are quick, fast in reaction. Okay, then you can do that. Then the time frame. Is it going to be a day trade, or is it you're going to wait for a longer time, like a few days? So usually, for me, I prefer swing trading. Swing trading meaning that you wait for a turning point. Okay, the price drop for a while, and then you see the stabilize, and then when it turn up, break the trend line, and then that's a swing trade. Okay, so this swing trade may come in like once in 3 weeks time, may not be all the time, every day. Okay, so the reason for a swing trade is that it depends on your personality. Because for me, I'm a very busy person. I do not have the time to sit in front of the computer to look at the screen for each of the short trade. Okay, I can only afford so much time, so little time, so I can go for a longer swing trading. So when I log into a position, it could be days. Okay, it could be days until end of the week. Then I will sell the position. So this kind of trade is like you got to be patient. You got to wait for the trade setup, okay, in order to have one opportunity. So patience is also one of the strategy or your character that you must have for trading. You must wait for the trend, the pattern to form, then you act on it. Okay, so you cannot be too rushed and then too impatient, then you will spoil the whole thing. Okay, so this time frame, as you trade more, then you will know which time frame suits you the best. Okay, so if you are quick temper, you are fast in reaction, everything you want fast, then maybe you can trade at a shorter time. Okay, and when you trade at a shorter time, perhaps you want to make your target very small as well. So maybe 3 points you will move, you will go. Okay, then you will not set like a 10 points kind of a target. Okay, because your time frame is so short, so you have to in and out most of the time, or even 1 point, 2 points also can, depends on your style. Okay, which month contract for FKLI will be the current month contract better, it's more liquid. The target profit depends on your time frame. Okay, so also depends on the chart pattern. If you see that there is a resistance at a certain point, there you know that the price most likely will hit below that resistance, and then it will turn down again. So maybe you can set your target profit at below that resistance point. Okay, and of course the stop loss. The stop loss will be your another trend line, maybe 20-day moving average, or it can be based on your preference, because since you said you want to have a 10 points kind of a target, maybe your stop loss is 3 points. Okay, or for swing trading, you can have 10 points to 10 points even, because you know that overall it's going to turn up. Okay, and then you are able to allow for a bigger bigger fall, and then before it rebounds. Okay, so it depends on your style. Okay, some people, they are able to withstand the kind of volatility. Then you can set a bigger stop loss. Okay, if you can't, then you set a smaller stop loss. And then when you set a bigger stop loss, make sure you have enough money in your account so that you don't get a margin call. Okay, then I also like to share with you this four charts here. The first one is a 5-minute chart. The next one is a 15-minute chart, and then you have a 30-minute chart, and then you have a 1-day chart. Of course, when you want to look at the big picture, right, 1-day chart will be the best. Okay, then if you are looking at day trading, I have tried the day trading, but it's not my personality. It doesn't suit my personality because my mind get too stressed out because of you need to be very, very focused as a day trader. So as a day trader, 5-minute charts will be good for you. So what you do is that, okay, let me see if I can bring you this. This one is the Bursa station. I opened up the 4 chart here. And then this one is a 5-minute chart. So today is 13 here. So you can see that starting from 13, this is today's price trend, 5-minute chart. Okay, so you can see every 5 minutes, there's 1 bar here. Every 5 minutes, there's 1 bar here. Every 5 minutes, there's 1 bar here. So let me do like this. Okay, so say you stop at yesterday. Yesterday was closing at 1650, right? That was 5 o'clock. You stop at 1650. So today you start at 8:45. So 8:45 over here, the first bar was 8:45 to 8:50. 5 minutes, and then this bar will come out here. 1 bar will come out in front of you, and then another 5 minutes gone, another bar come out. Okay, so if you want to trade the trend line, one of my strategy is to trade the trend line. You can do this. You draw 1 trend line up here. Okay, then when it violates the trend line, that's a sell signal for you. So when you see the trend line violated, the next bar you can short already. Okay, and then when you short, and then you put a resistance back at the, you see this candlestick or not? The red bar candlestick. Usually I will put my stop at the top of this previous candlestick bar. Okay, I repeat. Just now I have this first bar come out, right? Then this first bar already violate my trend line. So then it's a short opportunity for me. So I sell short. So I sell short around here, okay, around this level. Then where do I put a stop? I put a stop at this, the height of this first bar, the red color bar. The height of it is around 1650 or 1651. Okay, so that's my stop. Okay, then if the price hit that, I will have to close my position. So my stop for this is suitable for day trade. Day trade, it's not a swing trader, it's a day trade. So for this stop, I repeat, is the height of the candlestick bar over here, which is the top here. You see the height is from here to here, right? This is the range of that candlestick. So I put a stop right at this level, 1651, I think. Okay, then you let the profit runs. Okay, then you move again. Okay, let me click again. So you move as you move another 5 minutes, so the price keep dropping. This is the first 15 minutes that I was talking, that usually if you want to make some big gains, usually the first 15 minutes is volatile, and then you can make gains. And then when it hits, if for example, for me, my 1 day profit target is 500 only. So one day I hit that 500 ringgit in the first 15 minutes, I will have to stop trading for the rest of the day. Okay. So it depends on your target. Okay. So the reason why once you hit your target, you stop trading is because the less trade you involve, right? That means your risk is smaller. Because you keep trading, of course your risk is exposing your risk. Okay, so once you hit your target, so you just stop trading. Then you conserve, because when you don't trade, there's no risk. All right. All right. Then the as the price drop, right? Then you start to draw another trend line here. I hope you can understand what I'm doing here. Okay, I draw another trend line here. Another trend line here. Okay. So this is a down channel. Down channel. So you just wait for the this to move 5 minutes, and then keep moving until you see this thing happen. It's a doji, it's a cross, it's a doji. So that means the trend could be changing. Okay, so true enough, you have one green bar. Okay, since I want to focus on the short, right? So one green bar, I ignore the green bar. I look for short opportunity again. So another opportunity comes here, because if I were to draw another trend line here, okay, excuse me. So you can see that this red bar has already violated the trend line here. So also another short opportunity for me. So when I enter at the second bar here. That means before the second bar former, I will have to enter already. And I have to put a stop where? At the height of this first red bar. Okay, at the height of this first red bar. And then I let my profit runs. Okay, and then I see what's happening. Okay, so another 5 minutes gone, then you see a doji sign. Another 5 minutes gone, you see a red bar. So you just let it run, let it run. Okay, let it run. Because why? You have supposed to draw a trend line here. Okay, so draw a trend line here. Okay, as long as it is in a down channel, you just let the profit runs. Okay, let it run. Okay, click. Okay, let it run, let it run until over here I can draw. Okay, you see there's a violation over here. Then you close your position. Then you wait for another short position. But over here, there's no short. That you wait for the green bar, because when you close the position, you're supposed to see that the price will go up, but it didn't. It go down again. So, but you already missed the opportunity. So you just wait. Okay, you don't go in here. So you wait until you see a uptrend line here. Okay, this uptrend line, that means you are waiting for this uptrend line to be validated. Then that's another shot. Okay, but however, if you look at the overall picture, it has been like falling and falling. The chances of falling may be reduced. Okay, as the volume reduces, the chances of falling may be reduced. So then you better stop. Okay, you just, the chances of a short opportunity will be less. So maybe over here you are already hit your target already. So you can rest for the rest of the day. Okay, sounds easy, but actually when you practice, is a lot of emotion involved. Okay, because this thing is already happened. So when we draw lines and then when we talk like that, it's like there's no emotion involved. But when you are involved with this, with the emotion, it's very difficult for you to act sometimes. Okay, you have to try. Okay, so for a starter, FKLI is the best futures contract for you to start. You don't try the CPO yet. You try the FKLI first. And then this is for the day trade, okay? And then for the swing trade, I will go a day 1 day chart, okay? So that I can see clearly for the swing trade. So this is a nice swing trade for me. And it will go up. And then, okay, so back to here. So this is the trend breakout strategy. Okay, so this strategy is the oldest, most traditional kind of strategy that you can think of. You can, of course, you can apply into a 2-minute chart, 1-minute chart. It's up to you. It's your research. You, based on your research, you see whichever suits you. Okay, then you use that finding. Okay, what is suitable for me may not be suitable for you. So you have to do your own research, and then you can trade better. Then another one is the gap up field. Now this one, usually I would use I will use this as a backup. Like if I see there's opportunity, then I will use. But most of the time I will use the trend line. So this another strategy whereby you see a gap up here. Gap up meaning that the price jump. There's a space here, and then the price jump up. Okay, then there's a bar there. Okay, so this is gap up. So when you have a gap up, usually it's supposed to be bullish, right? However, when this gap up followed by the price drop, and then this price drop to fill up this gap. Okay, this price drop here to fill up this gap. So it means what? No more positive, bearish is coming. Okay, then however, you can see that sometimes the price will continue to rise, and then it will fall again. Okay, so but usually if you see this, right, usually you will have to go in at this point. But however, if you go in at this point, remember you put a stop loss at the height of the previous red bar, and then if it break up, you have to close the position. Then you have to wait for another opportunity. And then another opportunity is that you see that there's a double top here, the double top chart pattern here. So maybe you can draw a neckline here. And then when you draw a neckline here, and then when this point here break through the neckline, that's a great short opportunity here. Okay, so I would think that this gap up strategy is a backup strategy if you want to trade. Make sure you have a stop. Okay, make sure you have a stop. However, for this gap up strategy, it's very good for the US stocks. Okay, very good for the US stocks, but not so good for the FKLI. Okay, honestly, not so good for the FKLI. Okay, money management. A few tips here. Number one, have a maximum dollar stop loss. Okay, my stop loss is, let's say 200 ringgit or something. So you must have a maximum stop loss, or 500 ringgit. Okay, depends on your stop loss strategy. So this takes discipline to administer. Then find trades with the solid risk reward ratio. Okay, you always look for the trade that is highest probability, because when you are looking at the trading, right, everything is about probability. So the probability for the chart pattern kind of trade is much higher than any other. Okay, because when you have a chart pattern that form over a period of months or period of time, and then when that chart pattern is validated, this kind of a trade is called high probable trade. Okay, when it's chart pattern. Of course, trend line is a normal kind of a trade now, normal kind of trade, and then but you must have the stop loss strategy. Do not average down and take breaks. And then if you are really in a losing streak for like 2 consecutive losing streak, right, then maybe you just need to take a time out. Okay, go out, and then maybe you can just stop for the rest of the day. Avoid higher risk trades. Okay, that means high risk, high return. Okay, sometimes when you have this, you are not sure about, you don't see any chart pattern, you just guess only, then that's high risk. Okay, so avoid that. Stick to your niche. Okay, if you are good in shorts, you stick to it. If you're good in long, you stick to it. If you're good in identify the chart pattern, you stick to it. If you are good in identifying the bottom, then you stick to it. Avoid vengeance trading. So I want to revenge. I lose so much money, I want to revenge, I want to get back. Avoid this thing. Okay, because you are emotional already. Once you discover you are emotional, I think you better stop. Okay, because you will make more mistakes when you are emotional. Okay, so in summary, select the instrument to trade. In this case, I would advise FKLI. Okay, if you are new, have a few strategies on hand. Okay, like what I say, can be a trend line strategies, can be a chart pattern strategies, or can be a gap up strategies. Okay, identify the most favorable risk and reward ratio. Okay, so this one is the risk and reward ratio also depends on your support and resistance. Where is the support and where is the resistance, so that you know that your support is also your risk. Okay, how much is your risk that you can lose, and then your resistance is your reward. Take profit and cut loss according to your plan, and review your trades, reflect on each trade. So I hope today I've covered as much as I can, and I have shared with you my strategy. So I hope this can help you in your trading. So back to you, Smita. Smita?
Okay, thank you, Pauline. Okay, I just
Yeah,
confirm
overrun
that.
my time, so sorry.
That's okay.
Any questions? Open for the
Yeah,
questions.
so now any questions that we have? Yeah, we got quite a lot of questions.
Yeah, I hope I can answer as much as I can.
Okay, so the first question is where to get the list of points marks for the FKLI components?
Where to get what?
The list of points or marks for the FKLI components.
Oh, I see. Okay. In fact, I opened the website, but I forgot to show you. Okay, you can go Google top 30 KLCI component stock, and then you will come to this Malaysia stock.biz. All right, then you will have this the top 30 component with the market cap here. So you can see 13B, 42B, 51B. All these are the heavyweights. So you know that these heavyweights carry more weights, and their price movement will affect the KLCI index more. Okay, so this is a very good question. So I'm glad you raised this.
Okay.
Okay.
Then the second question, do you reference other markets like SIM, SCI or make decision?
Actually, my KL, if you're talking about FKLI, right, I will look at the KLCI index. That's it. But of course, US market like S&P 500, all this will influence as well, definitely. Yeah, when you're looking at the US market, of course, before you trade, right, you have to look at the overnight closing for the US market, see what's whether it's a up or down day for the US market. Then you know the sentiment for today's. And then once you discover the sentiment for today, then at the back of your mind, you must have a support and resistance for that day. Then you can trade.
Oh, okay.
You must have an idea. Yeah.
Okay. So when you look at large cap component stocks, what is your time frame? Daily chart?
What do you mean by am I talking about?
When
You're talking about that study the individual stock, is it?
yeah,
When you're studying at the individual stock, I look at the daily chart.
okay. So for our next question,
Just to get the overall fundamental. Yeah.
oh, okay. So
Okay,
next question, since FKLI is monthly contract, do you draw trend lines based on KLCI?
KLCI and the FKLI, I do trend lines on these two. So the KLCI will be our KLCI index, the main one. Then I draw trend line on that, and also draw trend line on the FKLI contract. Okay, I show you this one. You see that there's this June, July, September, all these contract months, right? So this one without the months one, you click onto it, and that one you can draw trend line on that. I think I have come up with the trend line on this one. This is a futures contract, and then you can draw trend line on this.
Okay.
Yeah. Okay. Any question?
Yeah. So the next question, which market or indices in Malaysia you do technical trading?
Which market? What do you mean? Which market?
Market or indices in Malaysia?
So the FKLI, I do trading on the FKLI, and I also do trading on the FCPO. Does that answer your question?
Yeah.
These two.
Okay.
I don't do forex. I just do the Malaysian derivatives market because I feel that this market I'm more familiar. The chances of me to make money is higher.
Oh, okay. So then we'll go to our next question. Which combination of moving average is best for short-term trading?
Short term, what's your duration of short term? Is it like for me, short term, it could be days, or it could be weeks. So if you are looking at days or weeks that I normally look, it will be 20-day moving average.
Oh, okay. Okay, so another question is how to calculate each stock weightage into KLCI index?
That one is actually a calculation. Maybe you can Google it on the ways of calculating the index, because for index calculation is a pretty standard, either the CPI, consumer price index, all kinds of index, there's a calculation. That means you base on your weighting and then you times the value. So there's a calculation. You may Google it on the internet. Yeah.
Okay. Okay, so for our next question, in the beginning you mentioned about futures. So how futures or warrants influences the stock price?
Actually, I would think that the underlying equity, underlying instrument is more important. So it's not like the other way around. It should be the underlying is influencing the futures market. Okay. So I would think that it's a underlying instrument that is influencing the futures market, and not that futures market is influencing the underlying. Yeah.
Oh, okay. So for our next question, any software for practice on the technical analysis chart?
The Bursa station is very good. I highly recommend that.
Oh, okay. Okay,
But
next
for
question.
free, you can Google lah. You can Google.
Okay, okay. So the next question, what is the resistance and support of KLCI this month and resistance and support this year?
Okay, okay. This month I can say that we have come out from the bottom, which is 1,600 point. We had come out from that. So now currently we are actually recovering. So the support is 1625, and then the resistance is about maybe 1665, or hopefully it can go up to 1670. I'm not sure if it can go up, but for this month, it's June, maybe 1665. But the bottom is 1625. I hope that it will not break below the 1625, because when it break below the 1625, we are all over the downtrend again.
Oh, okay.
Yeah. For the year, that's a good question, because initially, I would think that for this year, at least we have to maintain at 1,600 points. That's my minimum.
Oh, okay.
So hopefully this one will be true.
Okay, so we proceed to the next question. Will stop loss help in gap down situations?
Oh, no, that's a good question, because when you are stop loss, right? Okay, when you put a stop here, and then when there's a gap, remember the gap is a space, right? That means they jump from one price to another straight away. That means they miss your stop loss price. So immediately your stop loss will not be triggered. It will be on another level down. So then you have to do a manual stop loss yourself, because the price has passed your price, and it moved to another level down. So they miss your price, and then they will not trigger your price. Yeah.
Okay. Okay, so for our next question, when you talk about FKLI, it means FKLI is a monthly contract worth 4,000. How do I sell before expiry contract, or do I need to wait for the expiry period?
You have to sell. You have to sell before the expiry contract. Usually for this spot month, you buy and sell. It could be within a day. It could be within a week. Okay, but however, I have tried one experiment whereby I just think that month is a up month. That means it's a positive month. So beginning of the month, I just put a long contract, and then I just wait until the end of the day. Then I let it expire itself. I didn't sell. I just let it expire itself. Then they will the exchange the brokerage house will automatically sell for you, will calculate for you at the settlement price. So But over that month, right, my heart is up and down, up and down, up and down because of such a long period of waiting time. So it's very stressful. So
Okay.
in the end, my trade is within 1 week.
Oh,
Yeah.
wow.
Mm.
Okay, so the next question is, which chart pattern is more reliable between head and shoulders or double top?
I would think it's head and shoulder. Head and shoulder when it comes to the when it's going down, okay? When it's going down, it's head and shoulder. But if it's from bottom to up, I would prefer to see a W.
Okay.
Yeah.
Okay, so for our next question, do you do spread trading or one-side trading is more frequent?
I don't do spread trading because for me, spread trading, the gain is very small. So then it becomes like you got to have a volume. I prefer swing trading. Swing trading and one-side trading. Like you go for long means you always look for long opportunity, or you go for short, then you always look for short opportunity. Then swing trading will suit my risk appetite also.
Oh,
Yeah.
okay. Okay, Pauline, I think that's all the questions for today because we're running out of
Okay.
time as well. Yeah.
Okay,
So
sure.
I will just take the control back from you.
Okay, sure.
Yeah. So thank you so much, Pauline. We have already come to the
Thank you
end
very
of
much.
the webinar. And
Thank you.
so, yeah, I'll just show the next. Okay, so for our next webinar will be on the 4th of July, same time, 8:30 to 10 p.m. And it's Chinese webinar. So if you're interested, you can register here. I'll just drop the link in the chat box. Yeah, so you can register for your session here. Okay. And so that's all for today. Thank you again so much, Pauline. And thank you everyone for tuning in tonight. So with this, we just end our webinar for tonight and see you again next week. Thank you.
Okay. Thank you. Bye-bye.
Bye-bye. Bye, Pauline. Thank you.
Bye.